Amy, I mean, Mike just talked about it, volatility being down. It's kind of incredible that even though we've been seeing these stark moves in the bond market in recent days, the S&P is now up over 8% in the past 2 weeks. It's recouped all of its losses since the Russia invasion. The Nasdaq 100 has gained almost 11%. What do you make of the market action we are seeing?
Yeah, look, it's pretty staggering. You know, if you actually take QQQs, even since mid-March, that's up 15%. And those bond-related proxies that you mentioned, an IEF or a TLT, is down 7%. And of course, VIX is basically back to pre-Ukraine crisis levels. And the question is, you know, has anything changed geopolitically that would justify that decline in uncertainty? You know, I think probably near-term tenors of volatility are too low now. In particular, even if you take out the Ukraine crisis, we're just heading into earnings, which historically is a seasonally good catalyst to own volatility and to see volatility rise.
Mike, just to go back to the 1994 example, I mean, how similar are we in terms of history? I mean, was inflation high in the early to mid 1990s? Does it actually serve as a closely related template for how the Fed could execute on a soft landing?
Well, Morgan, there's a reason that Fed officials love looking at 1994, because it was this nearly perfectly executed mid-cycle tightening that really didn't push things toward recession very dramatically. I would say there are some similarities. We already are seeing a sideways choppy stock market with valuations getting compressed as people expect the Fed to move. 1994, you also had a lot more labor market slack than the Fed was giving the economy credit for at the beginning. Unemployment was above 6%. The Fed was being very preemptive in trying to keep the economy from overheating, and unemployment fell pretty dramatically during the course of the tightening cycle. Corporate profits did well. So I think you have some of the makings, but we're at higher absolute valuations right now. And quite intentionally, this Fed is not trying to be preemptive. They came into this inflationary period saying, we're going to let it run a while. We're not going to try to kind of anticipate it and get in front of it. And that leaves us in a very different spot, I think, than the starting place of 94.
You know, it's another morning in which we're looking at various curve inversions. Today it's 530s, and that's inevitably met with the response that QE distorts the overall curve, and we won't really know what the true curve looks like until we start reversing that purchase dynamic. Is that true? Do you believe that?
Oh, if that's for me, Carl, I don't think that we can necessarily say, oh, because the Fed's running this huge balance sheet, that all of a sudden the longer end yields are not reflective of something. We saw them. We've seen them move from 1.7 to 2.5 in, you know, a couple of months' time. It's not as if they can't move relative to supply and demand. But I do think you can say that the yield curve inversions themselves are not necessarily telling you something specific about the economic cycle. They're saying there's a certain window where the Fed can hike. It's front-loaded. After that, we don't think they can actually keep or get rates much higher, and therefore that explains some of the kinks in the curve.
Amy, you just touched on earnings. I mean, it's pretty incredible to think we're about to close out not only the month, but the first quarter. So how would you be advising positioning coming into that season, which is perhaps more critical than it has been in a really long time, given the fact that other dynamics, more macro dynamics in the market are very different than they were, say, just a couple months or a year ago?
Yeah, I think it's extremely critical. And historically, when you look to past earnings seasons, you know, there are a couple of things that become very clear. The first thing is that, you know, in the first 8 quarters, the first 2 are always times to own volatility. So, you know, we're positioned to own that volatility, in particular, as we see near-term volatility having declined. The other thing I would say is, you know, we also looked back into the 1990s, looked past kind of the last 30 years to different volatility regimes. And when you enter different cycles in a very high volatility regime, which we're still in, we're still at a VIX kind of above 20, that's typically pretty bad for stocks. Over a 30-year period, a volatility regime kind of in the medium to high range gives you an average market year of about down 10%.